Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be talking about selling puts for the very short-term time frame. There are some traders that look to hopefully increase their income potential by selling short-term trades, try to maximize that time decay. Is it free money, as I've actually heard it described before by some that I would consider to be a little bit misguided? Not really. We need to weigh the pros and the cons of this strategy. We're going to be talking about that approach. We're actually going to be planning and placing an example trade. Should be a great discussion. Before we can get to any of that, though, let me first of all say hello to everybody out there in YouTube. Great to see some many familiar names. Hello there, Mark and Eva, Kevin, Mighty Mouse, David, NK, Tony, Jackson, Life in the Fast Lane, Ron, and on the list goes. Thanks for being here today. I always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Monday webcast series. It kicks off promptly at 2 Eastern time. We'd love to have you in the live stream audience. Also, we have my very good friend, John McNichols, going to be hanging out in the chats. John's going to be addressing any questions that I can't get to. Just during the natural flow of the presentation, John and I have been working together now for over 20 years. He brings a ton of knowledge to this discussion. So thanks for having my back there, John. And John and I would like to issue an invitation to everybody listening. If you have an account with X, give us a follow there. You should be following your favorite presenters on X. You can find us there. You can find John there at John McNichol CS. You can find me there at Cameron May CS. But let's get into this discussion of selling put options on what are called weekly contracts, or weeklies. Another term that's used for those. But as we do, of course, we need to consider the risks associated with this approach and other approaches. This is important information, so bear this in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for the day. What are we going to be spending our 45 minutes on? Well, I've already told you how we're going to spend the bulk of the time, but first, I want to take a quick peek at some of our existing positions. It's been a little while. I've been on vacation for much of the last month and a half or so. So good to be back, but I got to play a little bit of catch up. So we're going to be taking a look at 4 existing positions and 1 position that was already wrapped up while I was on vacation. Then we're going to take a quick peek at the markets, maybe spend a minute on it, but that's to set the stage for our discussion of selling put options for income in the very short term, selling weeklies for income. What are the pros and what are the cons of that approach? And we'll wrap it up with that example trade that I promised. All right. So let's go right to the Thinkorswim desktop trading software platform. And here are those current positions: Apple, Abbott, General Electric, and Tesla. Let's start here right at the top. Apple is a position that we've been in for a while. We've been employing what some refer to as the wheel strategy. Originally sold a put, got assigned, started selling covered calls on the stock shares that were assigned to us. But let's go. If you look at this, you think, oh, this is terrible. This thing is way underwater. Profit or loss since we opened this position is up $3,200. No, that's only the current stock position plus the call that we've sold against that. So we have the stock shares plus that 225 call. We are still underwater, just not as much as this would indicate, because there have been profitably concluded related positions already on this Apple. So here we are on Apple. Let's hide this left column for just a minute. We don't need that for the moment. But we originally sold the 21st of March 235 put, which was assigned. Now that left us with $3 profit realized gain on the put that we sold, but we were assigned the shares at 235. You can see where those are right now, $200. Yeah, we're definitely underwater on those shares. But remember, we have that $3 gain on the put. We then sold a 17th of April 235 call. That was closed for an 80-cent profit. So there's $380 in options realized gains on the premium, setting the commissions aside. Then we sold a 16th of May 230 call, adding another $1.49 in profit. And finally, we've sold the 20th of June 225 call, which we are still in. Now, we're still solidly below our break-even point, which is up here at 227.30, and the stock is down here at 283. So we are $2,700 underwater. Not a great story. We don't make profits on every single trade, right? That's sort of reality. This may recover eventually. We might be able to sort of get our ox out of the mire there, but we'll see. Now, that's Apple. Let's take a look at Abbott. Abbott, we just own 100 shares of stock at the moment, but here's its history. So with Abbott, we bought the 100 shares at 128.68, sold a 16th of May 135 call. That expired. So we kept the premium here, $1.32 profit. And you can see we can add that now to unrealized gains on the stock. Bought the stock at 128 and change. It's now trading at 133 and change. So that trade's doing just fine. What we might consider at this point is maybe selling another covered call. It's just a stock position. The trader might look at previous highs, just like we did before. Maybe sell up here at or above that level, 135. What could we get if we were to get back into a 135 call? Maybe for the 20th of June. Let's go have a look. 20th of June. 135 call is about $2. That's about not quite 1.5% for about $18 worth of potential work. Obviously, we'd be putting a cap on the potential upside of the stock, but if we did get assigned, we'd be selling at a higher price than we paid for the stock. So how about we do that? Let's do that. Let's sell that 135 call. Let's click on the bid price to create that sell order. We always want to check our quantity, make sure that we're selling the matching quantity for the number of shares that we own. If we want to contract for every share that we have, sell the 135 call. Let's see if we can maybe get $1.85 out of this. So I'm going to leave that as our limit. Anytime we submit a limit order, there's a risk the order might not fill, but let's click confirm and send. Selling that one call. This is going to tell us there's an infinite loss potential. That would be the case if this were a naked call, but we're selling this in the account where we already own shares, so it's not a naked call position. Looking to get it all $185 credit. There is a commission of 65 cents if that fills. So let's send this off. See if we can get it filled. We'll let that work for a moment. As it does, let's move on to our General Electric. And by the way, when we've placed an order and it hasn't filled, it'll show right up here under working orders. Now, we sold that for 191, so that's in our filled orders. Great. General Electric, what's been going on with GE? Here's how that position stands. Bought 100 shares for $218.55, sold the 20th of June, so those contracts expire still about 18 days out. But you can see we bought the shares down here, sold the 230 call, and the stock has moved straight up through this. This illustrates one of the trade-offs for selling covered calls. If we do get assigned, all right, well, we sell the shares for about $12.50 for more than we paid for those. That would be a realized gain on the stock. In addition to the $2.99 that was collected for selling the call, that would not be a bad exit. Sometimes it's a forced profit that is required of the trader when a contract is assigned on a covered call. But the trader might feel a little bit better if they just own the shares as they're rocketing up, right? That's one of those trade-offs. But for right now, that trade is profitable. We'll let it continue to climb, continue to work. There's still, in leaving it there, though, there's the possibility it could reverse, come back down below the 230 strike, which could be okay. If it collapses down below our price that we paid for the stock, now we're in a position where we might actually be losing money overall on the trade. But as of this moment, doing fine. Let's have a look at Tesla. Our Tesla position is just another covered call. Bought the shares at 233, sold the call for 970, but we actually had a position on this before. So this is our Tesla position. Let's type in Tesla. And if you're wondering where all of these graphics come from here, the lines and the colorful text, I just draw those on just to keep a track record of our trade history on these trades, where we're commonly getting out of a portion of the position and getting into something else that's related on the same underlying security. Hey, Mark, thank you. Yeah, excellent timing on the Tesla call. Bought the shares right there. Yeah, you can go back and watch the archive. Sometimes, people say, no, you didn't, Cameron. That just is too optimized. You can go watch the recording. That was the day that we bought it, 233.07. Sold the 17th of April 280 call right here. And you can see as of that April 18th expiration, we're still solidly below, but then rallied up. We sold another call. This is the one we're currently in. Initiated that trade right here on the 12th of May. So that position was taken, right on this red candle. And interestingly, Mark, we'll see how this goes, but we've come right up to our strike that we sold, where we start to get elevated risk of early assignment. Early assignment risk is always there. It just tends to be lower when we're further away from expiration and if the contract is out of the money. Came up and touched that strike, and we've pulled back. So really, this trade is going just about as well as could be expected. It's a highly profitable trade at this point. Not every trade works out, but we did have one other trade I wanted to talk about. We had a position in Wells Fargo, WFC. Why is it not in our existing positions? Well, here's what happened. So original share purchase price, $70. Along the way, we sold an $80 call that we closed out for $165 profit. We sold a $72.50 call, closed that for a $122 profit, and then the stock started to fall below our break-even point. We got pretty far below that break-even, even sold a call below what we paid for the stock. Bought the stock for $70, sold a call for $67.50, and the stock shot up above $67.50, and that was a sign. So you think, oh, Cameron, what'd you do? Lost $250 on the stock, true, but along the way, made $165, $122, $123. We actually closed out with a break even down at $65.90. So selling at $67.50, net made $1.60. Not a huge profit, but made some money across all of those positions, setting again the commissions aside here. So that one's done. So that's our existing positions. Let's see what's going on with the markets. In a pretty cooperative market while I decided to take a breather from it. I left for vacation, right? Where was that? April 18th. Took some time on and off over the last month or so. But yeah, the S&P has been coming up. Take a look, though. What might a trader see in this behavior over these last maybe 3 or 4 weeks, where the S&P rocketed up? It moved up pretty sharply, and it's gone into a period of consolidation. What might a trader call that when we get a strong move up and then a consolidation where the highs are coming lower, the lows are going higher? Some might actually refer to that as a pennant pattern. Pennant pattern is among the price patterns that's considered to be a continuation pattern for price pattern traders. If they see this sort of a behavior happen, they see, ooh, there's something that got traders excited, driving prices up. Maybe there's just a little bit of back and forth between the buyers taking a breather, sellers coming in to buy up any, sellers coming in to buy. Forget that. Buyers taking a breather, sellers taking maybe some profits off the table, but still enough buying there, picking up any shares that have come down a bit, that we get a net consolidation. This might just be seen by some traders as a pause before a possible continued advance in price. We'll see, but let's say that we're putting ourselves in the shoes of a hypothetical trader who's maybe looking for income, and they're going to use a bullish option strategy to pursue that income, maybe because they think the stock market is pretty bullish at the moment. So let me see if I missed something here. I see some back and forth chat. NK says, how are you getting assigned in a paper money account? It's a good question, NK. So paper money, just so you know, early assignment is not a thing in paper money. It definitely can be a thing in real life, but nobody's assigning fake trades in a paper account before expiration. No early assignment. So it doesn't really replicate early assignment risk, but we always have to be aware of that. But the system knows how assignment works, at least if we get to expiration, whether in the money or out of the money. So if it's in the money, those contracts are assumed to be assigned. Did they actually get assigned? No, it's just a paper. It's just a manufactured I don't know simulation. That's what it is. That's it. Yeah. So it was. We just assume it's assigned, and then the system treats it as though it were assigned, and it gives us a pretty good experience that way. A pretty realistic experience. But it's not like somebody out there actually wound up with some fake shares of stock. Two Phones says is a pennant pattern same as a bull flag. Yeah, for all intents and purposes, it really is. Yeah, the interpretation is basically the same. The physical structure of it's very similar. Yep. So whether we see this as a pennant, which falls into that general category of flag patterns, or we call it a flag, the assumption is the same. It's a hesitation following a strong advance, maybe preceding another strong advance. So on that technical evidence, let's say that our trader is going to go out and look for some income, but maybe they're attracted to the idea of selling very short-term contracts. And let me exaggerate this a little bit. For today's example, we're going to be using Microsoft, but I'll just let you look at that chart for just a moment while I lay out the technical stage for this proposition I'm about to make. This is not a proposal that everybody should be doing this. It's always just for educational purposes. But if I were to draw up an ideal income strategy for me, that would be, I would love to sell a contract that has no chance of being assigned. It pays a huge premium and it expires 2 minutes from now, so I don't have to worry about anything going wrong between the time I initiate that contract to the time that the contract hits expiration. That sounds fantastic. Well, obviously that's an exaggeration. You know, I want $1 million premium that expires in 2 minutes and I don't have to worry about anything. It's just free money. That does not exist in real life. But some traders will take at least the spirit of that concept and use that as motivation to sell weekly contracts that are maybe within 5 days of expiration. So I'm going to look at Microsoft. Let's set a technical outlook for it. What might attract a trader to this? Yeah, Kevin, you'll take 10 of those sorts of scenarios? Yeah. Yep. But we need to talk through the pros of selling very short-term contracts for income, but also the cons of selling them. We have to weigh these things intelligently before we decide whether or not a trade will play a role in a trader's portfolio, right? Anyway, what's going on with Microsoft? Well, what some traders might see as being quite significant is that there's been a price ceiling here between 455 and 450, stretching back for, what is that, about 10 months now, where Microsoft traders just have not kept price above 455 at all for that entire time frame. And finally, we've pushed up and through that. And for some, they see that as that might be setting the horses loose. They're about ready to run from here. Not guaranteed. Time will tell. But let's say that our trader thinks that this break above resistance might set the stock to move up. There is one more point of resistance right back there. But beyond that, not any really obvious technical obstacles on this chart that I can see. So let's say that they're going to pursue an income strategy where maybe they sell down here at 450. Maybe they require the stock to be about 455 to dial up that. Oh, Greg says, is this a bullish engulfing? Right here, you're talking about today's candle looking like it could just about swallow up within its body. Yesterday's, certainly. The day before, yeah, it looks like it could swallow up the body of that candle, and the one before that, not the one before that. I think it has elements of a bullish engulfing, although I will say a bullish engulfing is we usually look for those at the bottom of a down move rather than at the top of an up move. So I'd say that it has some of the physical characteristics of a bullish engulfing pattern. but it doesn't fit the profile of where it should be appearing. Okay. All right, but does that matter to our trader who's just excited that we've broken up through resistance and holding that as a new support? Maybe it doesn't. It's nice to see a big white candle in any case, even if it doesn't qualify to carry a certain tag or title. So let's go structure our example trade. And we're going to stick with these weekly contracts. There are actually some contracts on Microsoft that expire in just 4 days. Now, for those that are new to options trading, you may notice with some stocks, all of the options in the options chain will be displayed in black on Thinkorswim. That is when we're using the light background setting. Whereas others will show purple. And that's calling attention to the fact that these purple ones are what we call weeklies or weekly contracts that aren't the typical or the traditional third Friday contracts that we've had now for decades. For a long period of time, contracts now these are just for traditional equity contracts, they assigned on the third Friday. That's what I got used to for a big chunk of the first half of my trading career. But then we had these things that are called weeklies introduced. And these are contracts that just expire at the end of each week. So this one expires Friday of this week. This one expires Friday of next week. Then we have a traditional third Friday. And then we have the fourth Friday expiration. And in this case, there's even a fifth Friday expiration because we happen to have Friday landing. Oh, no, actually, never mind. That's moving out into July. Anyway, you get the point. But for some traders, they're drawn to the fact that these contracts only expire in 4 days. Let's talk about the pros. Why are some drawn to this? Well, as we look at the 6th of June, let's say we look at a contract that's down below our support. That would be the 450 put. And I'm going to start there. Some traders would look at this, and if we were to sell that put, just to draw this in here, let me make a line here representing this Friday, which is the 6th, right there. There's the 6th of June. Here's the contract we're contemplating drawing. I even drew that back too far. Let me edit the properties of that trend line I just drew. And let's have that start today on June 2nd. There we go. This little tiny line right there, that represents the full timeline duration of this contract. Where do we need this stock to be if we're selling a put at the 450 strike as we cross that June 6th expiration? We just need the stock to be above 450. Look at that. We're way above 450. We're already at 461. This trader is getting into a contract that has actually comparatively little opportunity to go wrong. One thing that some traders like, this is a potential pro of selling short-term put options for income, is that there's not very much time for these trades to go bad. You know, that exaggerated scenario I just said, hey, let's get a great big fat premium that expires in 2 minutes. That would be awesome. This one doesn't expire in 2 minutes. It actually expires in 4 days, but we're only giving it less than a week for Microsoft to do something unexpected and mess this thing up for us. Yeah, Mark, we just need to be somewhere above 450. Well, that's a pro. What's an obvious con? Well, now con not meaning con man or con game, but not good. That's what I'm talking about. Well, a potential disadvantage here is in my hypothetical scenario, I said, hey, it'd be great to have something that expires in 2 minutes that pays a huge fat premium, $1 million. Not getting $1 million out of this trade. How much are we getting? Well, if we look at that 450 put, it looks like it's paying between 77 cents and 80 cents. That's $77 to $80. It's not a huge premium. However, it actually, on a day-to-day basis, represents a larger potential income than longer-term contracts. Yeah, Greg says the trade-off here is a lower premium received. Yep, on a dollar to dollar basis, and I think at this point what we need to do is start comparing this to other potential contracts. It doesn't look like much. So let's do a comparison here. Let's compare our 4-day contract. What if we were to do a traditional contract expiring on the third Friday? We're even going to move out beyond the third Friday of June. Let's go out to the third Friday of July. We're going to be comparing a 4-day contract to a 46-day contract. So this 46-day contract, that's 11 times. If we were to sell that, we'd have to wait 11 times as long to get to expiration. It's actually 11.5 times as long. So it's a much longer term contract. So if we think, well, if I'm getting $75-ish, it goes close to $80. I'm getting 75. What is it right now? Let's go back here and have a look. 77 to 80. Let's say it's 80. All right. If I'm getting $80 for a contract that only has 4 days on it, if I go out 11 times as far in time and stick with the same strike price, doesn't it only make sense that I should get 11 times as much money? Let's take $80. Let's multiply that by 11 times. Shouldn't we get about $880 if each day is paying an equivalent amount? Actually, if we go out here to the 18th of July and we look at the 450 contract, nope, it's not 880. It's actually fairly substantially less than that. There is a lower per day return available on these longer term contracts, and that's because of time decay, commonly measured by theta. Now, the traders that go for these short term, these weekly contracts, one of those things that we're going back over to the pros category, the potential advantages to a shorter term contract, is that on a per day basis, there can be a higher potential premium. And we can measure that distinction. Let's put ourselves in the shoes of two traders. One, trader A is going to sell the 4-day contract. Trader B is going to sell the 46-day contract. Mark says, let me see what you're saying there. All that extra theta changes the extrinsic value by a different multiplier. Might need a clarification there, Mark, on what you're saying, or maybe you're having a sidebar discussion with somebody else, but let's do trader A versus trader B for just a moment. Trader A sells that short-term put, 4 days. Trader B sells the longer-term put, 46 days. And then let's just say 1 day goes by. The same 24-hour period for both traders on this. These are selling puts on the same stock at the same moment. Assuming price doesn't move and volatility levels don't change, what is the unrealized gain for each? Let's go have an, oh, JB, you're getting there. Yeah, we need to talk about that. That's a good point. And it's definitely on, I always have an outline of points that I want to hit. And you've definitely picked up on one of those. But in any case, let's go back to our 6th of June contract and look at our 450. And I want to look at theta. Our theta says minus 28. That's an approximation, and it's accurate, assuming nothing else changes, of how much this trader might expect to either benefit or be negatively impacted by the passage of 24 hours. When we're selling this on an out-of-the-money option, this theta is working for the trader. So if we sell this put and allow 24 hours to go by, assuming nothing else significant changes, there'd be a 28 cent or a $28 unrealized gain on this trade. Let's compare that. Remember, $28 for 24 hours. Let's go look at the same 24 hours, same strike price, same stock for the 450 for the 18th of July, $11. $11 versus $28. There is basically 2.5 times the short-term income potential for the shorter-term contract versus the longer-term contract. So even though there's potential to make, it could be about $7.40 on this contract, it takes longer to get there, assuming nothing else is playing a role, price or volatility. And so that's definitely one of the pros of this strategy. Dragon Rider, you just go, wow, yeah. Okay, now let's go back to JB's question, or JB's observation here. JB, I'll make my apologies because I'm sure everybody has James Boyd on the brain because everybody just saw that great presentation that he just did. So I know that's not you. So when I'm saying JB, I'm talking about JB, the attendee here. But JB says, assignment is another risk. Here's one of the disadvantages, the potential disadvantages of selling these shorter term contracts. And another disadvantage that stacks on top of it because of this. One disadvantage here is that the trader, when there's very little time left on a contract, we're probably going to need to sell contracts that are pretty close to the current price. We can't go very far out of the money, or the premiums really start to dry up pretty quickly. So, for example, just moving down to $440 on a $460 stock, that's not that big of a price jump. So, but if we were to try to sell a put down at 440 versus 450, there's only 22 cents on that thing right now. If the trader wants to dial up their premium, they're probably going to have to move their price, their strike selection, closer to the current price of the stock. So here's what that creates. We have a strike price that's relatively close to the current price. It's not in the money, but it's getting there. Also, in the grand scheme of things, is this a huge amount of value for the owner of the put that we're thinking of selling? 76 cents, 78 cents, 80 cents. If they decide to assign this put, are they really giving up much? Probably not. So the combination of those two factors can dial up the risk of early assignment. So if the trader really didn't want to wind up owning these shares, this might not be their strategy. Selling shorter term contracts, these weekly contracts, can carry with it elevated assignment risk. So the trader needs to go into it with an even more heightened awareness of early assignment risk and a greater awareness that they might wind up owning these shares. And I picked Microsoft for the reason of really putting an exclamation point on this risk. I'm sorry, for the $80 or $77 or whatever we ultimately wind up collecting here, that's the income potential of this strategy that I'm selecting. If we are assigned early or just assigned at all, how much is that going to cost? 100 shares. Well, 100 shares doesn't sound dramatic. At $450 per share, that's a $45,000 commitment. So that's definitely not something to not be aware of. Mark says, I think it's about time I got assigned on something. Maybe you'll give this a try. We can always try it on paper money first, right? Now, these webcasts are never intended as a specific, a sales pitch for a specific strategy. But I think we're starting to see some of the pros and some of the cons. It can be quite attractive to dial up that day-to-day potential for income. For an income trader, there is a lot more day-to-day potential income selling these shorter term contracts than the longer term contracts. So that's one in the pros column. The trade-offs there being might have to sell closer to at the money, might have early, and these are sort of mathematical facts. Yeah, we're probably going to have to sell closer to at the money, and yes, there's going to be higher early assignment risk. Bruce, you're getting a little bit beyond this. Bruce says, well, how about a 30-point wide strangle, double the potential income and go further out? I get you there, Bruce, but this webcast series is actually called Trading Covered Calls and Short Puts, and we don't get into other sort of multi-leg strategies beyond that. That's a good question. I don't at all mean to be dismissive. It just doesn't fit in this series. All right, so let's see. Pros, more premium per day, fewer days for surprises. Cons, must sell closer to at the money, fewer days to recover is another thing. What if the stock drops tomorrow? Well, if we had 44 days remaining on the contract, we might think, well, it's not going my way, but there's enough time. Maybe it's going to recover. If it drops hard tomorrow, clock is ticking. We only have till Friday for this to get back up above our strike. It's in the money. Assignment risk is now even stronger. Yep. That can be a risk of this sort of an approach. Guys, let's go ahead and place the trade, though. Let's take the role of a trader who is just trying to go for these quick turnaround strategies, hopefully reducing the risk of early assignment, not giving it much time to misbehave, although any time is enough time to misbehave. But let's click on the bid price here, and I'm going to sell one of these things. And as I do this, just watch and think through, would this be the sort of trade that you might consider trading? I'm not telling you to consider trading. I'm just saying weigh the pros and the cons in your mind and learn from this experience as we're placing this trade. Might make 75 cents as our income. Let's dial this up, try to get 75 cents out of this. We're taking on a pretty big obligation. Someone has the right to sell shares to us for $450 just for the next 4 days. And let's confirm and send this order. Going to sell that one Microsoft 6th of June 450 put for a 75-cent limit, trying to collect a $75 premium. What's the maximum loss on this trade? If Microsoft collapses to zero in the next 4 days, or in the next 4 days before assignment, $45,000 it could be lost. Is Microsoft likely to go to zero in the next 4 days? No. Could it happen? Is it just within the realm of possibility? It's still there, so we have to be aware of this. There is a commission to be paid here. That chips away at our credit. If we receive $75, that makes our minimum acceptable credit $74.35. So let's send this off. You like that quote, Mark? That quote goes in your book. Any time is enough time for a stock to misbehave. I'll be clear with that. Let's see. Maximus Investor Guy says doing those short-term covered short puts or cash secured puts, I think is what you meant to say. What I misspoke. I think you intended CSP to mean cash secured put. Leads you into the wheel on assignment. Yeah, if we get assigned, we could treat this just as we did with our Apple position. We own the shares. The trader might choose to then start selling covered calls against that position. So for some, that might be totally acceptable. I would suggest that if we're selling into contracts where we are contractually obligated to maybe have to buy some shares, we should be prepared with a plan for what we're going to do with those shares. Let's see, Ron says, how's the buying power effect calculated on Microsoft put? Ron, there's quite an equation that goes into that. As a general rule of thumb, we might think about 20%. It can definitely vary from there, but that's a pretty good benchmark, sometimes more, sometimes less. But the quick way to confirm in any case is to just place the trade, start to place the trade. I'll just do this again just so you can see. If I click on that bid, let's do one more contract. I'm going to click confirm and send, and then we can just look to see what is the buying power effect. $8,000 is about how much margin this put might tie up, and on a $450 per share obligation, it's in the 20% range. See that? Anyway, I'll just delete that. But guys, we've accomplished what I set out to do today. We're going to talk about the management of this trade in the coming weeks. That's why I hope you'll join me each week. We talk about the front end and then the back end of these trades. So we'll take a look at this in the coming weeks, manage it as it goes. But I did want to talk through the pros and the cons of selling weekly put options for income. Hope you enjoyed that discussion. We're going to do a similar discussion next Monday, more discussions of selling puts. Maybe I'll go to the opposite end of the spectrum. Selling way out in time. Let's sell some leaps options puts for income. I know some of you are going to say, why would I want to wait I understand why somebody would go very short term. What might motivate a trader to go for years on selling a put? There could be some surprises in it for you. So maybe join me next week. That's going to be my plan. That's what we'll talk about. All right, because there can certainly be some logic there. In any case, everybody, thanks for giving me your time today. John, thanks for helping out. I have some suggestions for making sure that you're maximizing your resources with Schwab Education. Number one is that if you haven't subscribed to our YouTube channel, make sure that you do that. You can go down in the lower right-hand corner of the video window right now. Click on subscribe. It literally only takes a moment. It doesn't cost anything. But YouTube is where we house, you can join our live streams on YouTube, but also that's where we house our previous webcasts in nifty little lists according to the webcast series. So after you subscribed, you can just track us down on YouTube. Trader Talks Schwab Coaching Webcasts is the name of the channel. And you can find the playlists for our different YouTube series right here, including this one. So if I were to scroll down on our playlist, we have a bunch of different series. And we even keep some of this historical series that we have changed or that we've moved on to new series. Let's see, who did it last week for me? Because I'm looking for their picture. Anyway, we'll look for trading, covered calls, and short puts. It was Barb. I know it was. Where'd Barb go? I'd like to see her picture there. There it is. There we are. Trading covered calls and short puts. You can view the full playlist right there. You can watch Barb's webcast from last week, one that I did 2 weeks ago, Mike Fairborn. But they're all of my historical webcasts on this webcast series. So much that you can learn. The other thing that I would strongly recommend everyone do is that if you have an account with X, make sure that you're following your favorite presenters on that platform. You can find John McNichol there at John McNichol CS. You can find me there at Cameron May CS. This is the guy you're going to be looking for right there. Make sure that you are precise with these handles on X. When dealing with social media, there are lots of names that can be very similar. So close is not close enough. It has to be exact. Hey, Wendy, just subscribed. Fantastic. That's great to hear. Thanks for doing that. Enjoy those webcasts. Everybody, I will actually, let me say one more thing. I can see 132 people watching the live stream right now, and it looks like there are 46 that have already clicked the thumbs up. They already clicked that like button. If you would watch one of our webcasts and you enjoyed it, make sure that you click that thumbs up button. It's like a pat on the back. It's applause to your presenter. It also gives them a boost in the YouTube algorithm, helps their webcast be found by more YouTube viewers, and they can just have more people learning the pros and the cons of these sorts of strategies. So thank you for doing that. Probability Trader says you subscribe twice. That's not a good idea because that's unsubscribing, actually. And that, I know you're being funny, but I do like to throw that out as a reminder. If you've already subscribed, don't click the subscribe button again because it actually unsubscribes. All right. Anyway, everybody, thanks for giving me your time. I will look for you in one of my other webcasts. I have a new one every day of a trading week, unless I'm on vacation. I'll also look for you on X, but hey, whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.